Welcome back to Investing Talk Podcast.
Today we're looking at Applied Digital.
Applied Digital, APLD. For the last, 2 years, every single time this ticker crosses my screen, it's just lumped in with the Bitcoin miners.
Always.
It moves in lockstep with crypto. If Bitcoin has a bad Tuesday, Applied Digital has a bad Tuesday. But looking at this research, the vibe feels very distinct now.
It is completely distinct. And that's really the whole story here. We aren't looking at a crypto mining company anymore. Not really.
Right.
We are looking at a company that has managed to pull off one of the hardest pivots in the tech sector. They have transitioned from a crypto miner into a hyperscale AI landlord.
The landlord for AI.
Exactly. And the data from their Q2 fiscal 26, it shows this massive inflection point. So if you're still looking at this stock and thinking Bitcoin proxy, you are missing the entire thesis.
That is a bold claim because the market has a very long memory.
Right.
And, shedding that crypto label is notoriously difficult. Once you're in that basket, the algorithms tend to just keep you there.
They do.
But before we unpack whether they can actually pull this off, and I have some serious questions about execution risk, because building data centers is a lot harder than plugging in miners. As usual, before we start, subscribe, like, and comment to this video to support the show.
It really does help us out.
It helps us keep the lights on, so please go ahead and hit that button.
All right.
Okay, let's get into the numbers. You're calling this a hyper-growth inflection. It's a phrase that gets thrown around a lot, usually to, mask bad earnings or distract from a cash burn.
Right.
So prove it to me. What's actually happening on the top line?
The top line is effectively exploding. In Q2 of fiscal 26, which ended back in November, Applied Digital reported total revenue of $126.6 million.
Good.
Now, a number without context is just a number, right? To give you the scale of this, that's a 250% increase year over year.
250%.
A year ago, they were doing just over 36 million.
That's impressive. I'll grant you that. That's rare air. But we need to break down the quality of that revenue. Because if that spike is just from Bitcoin rallying and their mining rigs printing more money, then this isn't an AI story.
It's just another crypto cycle.
It's just a crypto cycle. We've seen that movie before.
And that is the absolute first thing I looked for. The split proves the pivot is real. So if you look at their reporting segments, you have data center hosting, that's the legacy crypto business.
Right.
And then you have HPC hosting.
HPC being high performance computing.
Right. The AI infrastructure, heavy lifting for large language models, all that generative AI stuff. That segment brought in $85 million of the total.
$85 million.
And the crypto side, $41.6 million.
So the side hustle has officially eaten the main business.
It's double the size of the original business now. I mean, that is the literal definition of a successful pivot.
Yeah.
They saw where the wind was blowing, they adjusted, and now the new business is twice the size of the old one.
I do notice the crypto side is still up, though. It's not like they just shut it all down.
No, not at all. It's actually up about 15% year over year. Their facilities are, fully utilized. But here's how you have to think about it now. That legacy business, it's just a cash foundation.
Okay.
It's there to keep the lights on, generate steady cash flow, while the real explosive growth happens on the AI side. It's the steady paycheck while they build the empire.
Well, let's talk about keeping the lights on. Because revenue is vanity, profit is sanity. I am looking at the bottom line here, and I see a net loss of $31.2 million.
Yep, it's there.
So they are tripling revenue, but they're losing $30 million a quarter. To the skeptic, and I'm the skeptic here, this looks like they are just burning cash to buy growth. Are they selling dollars for 90 cents?
If you only look at net loss in a heavy infrastructure business like this, you're going to get a really distorted picture. You have to look at adjusted EBITDA.
I had a feeling you were going to pull the EBITDA card.
Yeah.
It's the classic move.
Yeah.
But for anyone listening who feels like that's just financial gymnastics, explain why we should care about that here.
It's absolutely crucial here because of depreciation. When you build these massive data centers, we're talking hundreds of millions of dollars in gear accounting rules, force you to write down the value of those assets over time.
Okay.
That shows up as an expense, but it's not cash actually leaving the bank. It's a non-cash charge. It makes the company look like it's losing money on paper when it might actually be printing cash.
So it makes the company look poorer than it is from a cash flow perspective.
Correct. And if you strip that out to see the actual cash generation from the operations, they achieved a positive adjusted EBITDA of $20.2 million.
Positive 20 million.
That is the signal. It means the core operations are cash generative. They aren't burning cash on speculation. They've built a huge chunk of the facility, and now they're effectively just collecting rent.
So the argument is the net loss is mostly an accounting thing from all that upfront spend, but the business model itself is now printing cash.
Exactly. The CapEx cycle is front-loaded. You spend the money to build the building, and then you sit back and you collect checks for 15 years.
Well, let's talk about who is writing those checks. Because you can't talk about Applied Digital right now without mentioning the mega deal. This seems to be the big thing.
The mega deal. This is, I think, the single most important pillar of the bull case. They signed a 15-year, non-cancelable lease with a U.S.-based investment-grade hyperscaler.
Let's pause on that term, hyperscaler. We hear it all the time. Who are we really talking about?
We're talking about the titans. Amazon, AWS, Google Cloud, Microsoft Azure, Meta, the companies that are practically nation states. They didn't name the client, but investment grade narrows it down to that absolute top tier.
Add the terms.
It's for 200 megawatts at their Polaris Forge 2 facility. Total contract value, $5 billion.
$5 billion. Guaranteed.
Guaranteed. And I want to highlight a specific clause in these things called make-whole provisions.
Yeah, explain that. What's a make-whole provision?
Think of it like a really strict apartment lease. If you sign for a year and move out after 3 months, you still owe the landlord the rent for the other 9 months, right?
Right.
A make-whole provision is that on steroids. If this hyperscaler decides to change their strategy or stop using the compute for whatever reason, they still have to pay the full value of the contract.
Yeah, it provides a massive floor to the valuation. It's not, we hope people use our servers. It's, you owe us rent until 2041.
It basically turns the company into a bond proxy. You have revenue visibility for a decade and a half. That is incredibly rare in tech.
Okay, so
Yeah.
let's look at the bank account. Signing a lease is great, but you still have to build the thing. 200 megawatts of data center capacity is incredibly expensive. Do they have the money?
They do. They have what I'd call a fortress balance sheet right now. They're sitting on $2.3 billion in cash.
$2.3 billion. That's a lot of dry powder. But on the other side of the ledger, I see $2.6 billion in the debt.
They are leveraged, yes.
So net debt of $300 million. Is that terrible for a growth company? But high interest rates can kill you with that kind of debt load.
But context is key here. You have to look at the maturity dates. Most of that debt doesn't mature until 2030.
Okay.
And their cash position right now, that $2.3 billion, it exceeds all their near-term obligations. So they aren't facing a liquidity crunch. They have a runway.
It's a very long one.
A very long one. And since they're now generating positive EBITDA, they can service the interest. By the time 2030 rolls around, with a 15-year lease from a titan of tech, refinancing that debt will be a walk in the park.
That's a fair point.
Yep.
Banks love predictable rent checks. Okay, before we move on from fundamentals, I want to touch on the moat. Why does a hyperscaler go to Applied Digital? Why not just build it themselves?
It comes down to really 3 things: technology, speed, and geography. On the tech side, they have this proprietary design, Polaris Forge, which uses waterless cooling.
Waterless cooling. Why does that matter? Is that just an ESG talking point?
It is so much more than marketing. Traditional data centers consume millions of gallons of water. In places like Arizona or even parts of the Midwest, water rights are becoming the limiting factor for construction.
So they can get permits where others can't.
It just greases the wheels of regulation, which leads to the second point, speed. In the AI arms race, time is everything. Applied Digital energized their first Polaris facility exactly on schedule. They prove they can deliver.
And geography.
They build in places like North Dakota.
Not exactly Silicon Valley.
And that's the whole point. Land is cheap. Power is often cheaper, and the local governments want them there. It's just infinitely easier to build in Ellendale, North Dakota than it is in Northern Virginia right now.
So, cheap land, friendly regulators, unique tech, and a proven track record. Okay, the books look clean. The contract is massive. But Wall Street is a strange place. Let's see if the market actually agrees with this balance sheet. Let's pivot to the charts.
Yeah, the technicals are telling a very interesting story.
So is the stock price actually reflecting this pivot? Or is it still trading like Bitcoin proxy B?
We are seeing the formation of what I'd call a breakout narrative. The market is finally starting to reprice the stock. For so long, the algos just treated it as part of that crypto basket.
Right, the correlation was almost 1-to-1. It was frustrating.
But now you have analysts predicting the stock could soar 80% in 2026, and that momentum is coming directly from that revenue growth. The market is slowly realizing this is an infrastructure play, not a coin play.
I saw some interesting data on volume that supports that, the whale activity.
Yes.
Back on February 4th, Applied Digital popped up on these rare stock pick lists, showing significant options activity in large block buys.
And that is a crucial indicator. That isn't retail traders on Reddit. That is institutional accumulation. That's the big money looking at that $5 billion contract and saying, this asset is mispriced.
However,
Hmm.
and I have to pull us back to reality here, we can't ignore the Bitcoin correlation entirely. Recently, Bitcoin dipped below 68,000, and I watched the crypto stocks get hit. Applied Digital dipped with them.
It wasn't immune, no. In the short term, the algos still link them. But this is where the opportunity is for the human investor. We are seeing a decoupling.
You really think so? They still feel pretty entangled to me.
Well, the math dictates the decoupling. When the AI business is double the size of the crypto business, eventually the stock price has to follow the earnings, not the sentiment of a different asset. If Bitcoin drops and APLD drops with it, that's actually a buying opportunity.
Because the AI rent checks are still clearing.
Exactly. The $5 billion is still coming in regardless of what Bitcoin does. You're buying an AI company at a crypto miner's discount.
You're exploiting the algorithm's lag.
That's the trade.
The charts look hot, but what is the street saying? Let's talk sentiment.
Sentiment is really a tug of war right now. On one side, you've got this huge industry validation. They were just named Best Data Center in the Americas 2025 by DeoCloud.
That's a legitimate award.
Yeah.
That carries weight with the people who actually make the decisions.
It does. And then you look at the pipeline. They are in advanced discussions for 3 additional sites. We're talking about 900 megawatts of capacity.
Wait, let's do the math on that. They just signed 200 megawatts for $5 billion.
Right.
So 900 megawatts.
That could be.
If they land those at similar economics, you're looking at potentially over $20 billion in future contract value. The pipeline is just massive.
That's staggering. But let's look at the other side. It's not all sunshine. I was reading an article just yesterday titled 22 Reasons AI Data Center Construction is in a Bubble.
I saw that too. It's the counter narrative. The fear is we're overbuilding. And even if Applied Digital is solid, they live in a neighborhood that people think is overvalued. If that AI bubble narrative takes hold, they get dragged down with everyone else.
It's a real risk. But there is a specific catalyst for Applied Digital that might help them stand out. The Chronoscale news.
The spin out.
Yes, the planned spin-out of their specialized compute unit. The shareholder vote on that is expected in the first half of 26, probably March or April.
So very soon. Why do that?
To unlock value. It's a classic move. You separate the landlord business from the compute business. You let one trade like a REIT and the other trade like a tech growth stock. It usually results in a higher combined valuation.
So overall, the sentiment is what?
It's neutral to bullish. We have this incredibly bullish, company-specific story fighting against a bearish headwind of sector-wide anxiety.
It sounds almost too perfect, which always makes me nervous. So let's look at what could go wrong. Let's really dig into the risks.
Okay, the bear case.
Risk number 1. The macro bubble. If the AI hype bursts, valuations compress. It doesn't matter if you have a contract. If the market decides data centers are the new .com bubble, the stock goes down.
That's a valid macro risk. If the tide goes out, all boats get lower. But the rebuttal is that the contract is signed.
Contracts can be broken.
They can, but the tenants are companies like Microsoft, Google, Amazon. They aren't going bankrupt. That $5 billion lease is legally binding. So even if the stock market valuation compresses, the cash flow into their bank account does not stop.
Okay, fair enough. Risk number 2, execution. Construction is hard, especially in North Dakota in the winter. If Polaris Forge 2 is late, that revenue guidance breaks, and Wall Street will punish them.
Absolutely. Execution risk is probably the most tangible day-to-day risk, but look at the track record. Polaris Forge 1 was on schedule, they've proven they can do it, and again, those make-whole provisions mean their partner is financially committed to helping them finish on time.
Risk 3, the crypto drag. 33% of revenue is still a third of the business. If Bitcoin enters a prolonged winter, that cash-generative foundation cracks.
It would hurt, yes. But remember the velocity of growth on the AI side. Every single quarter, that crypto percentage gets smaller. In a year, it might only be 15% of revenue. In 2 years, maybe 5%.
So they're basically growing their way out of that risk.
They are diluting their own risk through pure execution.
All right. We've looked at the revenue jump, the balance sheet, the institutional buying, the risks. It's time. Final verdict. What's the score?
I'm giving this a bullish score of 8.5 out of 10.
8.5. That is high.
It is. And here's the thesis in a nutshell. Applied Digital has successfully crossed the bridge. They are no longer a speculative miner. They are a profitable, hyperscale landlord.
Give me the elevator pitch.
Okay. You have positive adjusted EBITDA today. You have $5 billion in guaranteed future revenue. And you have a 900-megawatt pipeline that could triple the company again. The floor is the guaranteed cash flow. The ceiling is the AI pipeline.
So what's the trade?
It's a 6 to 12-month multi-catalyst trade. You've got the chronoscale spin-out, the next earnings report. My advice: watch the price of Bitcoin. If crypto has a bad week and drags APLD down with it, you thank the algorithm for the mistake and you buy that dip.
You're buying premium AI infrastructure at a crypto discount.
That's it, exactly.
The fundamentals provide the floor, the AI pipeline provides the ceiling. I like that framing. It's a much more compelling story than just hope Bitcoin goes to the moon.
It's a real business now.
Well, there you have it. A really interesting look at the transformation of Applied Digital. It's going to be a fascinating one to watch.
It definitely will be.
If you enjoyed this analysis, make sure to subscribe, like, and comment to support the show. Let us know what you think. Is the AI bubble real, or are we just getting started? We'll see you in the next one.